protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
Welcome to the Money Unleashed podcast. I'm Eric Johnson, joined as always by Kyle Allyn, and we are the vice presidents of Hoffman Financial Group. We bring you new episodes every Monday and Friday, so be sure to subscribe wherever you get your podcasts. Now, Kyle, what we're going to talk about is 401ks and what's in people's 401ks. Oftentimes, I find when we're doing a portfolio x-ray for somebody, people have no idea what they're investing in. In fact, a lot of people actually they punt. They go with the easiest thing that they can possibly find, whether that be a target date fund, or sometimes I see the opposite where they have done too much and they've got 6 or 7 mutual funds and everything's spread so far out it's not performing. Let's talk about a little bit about 401ks and what people are finding inside of them and how we can help them with the performance of those.
Yeah, so let's talk 401ks for a second. So about 35% of America has access to a 401k, so that's about 72 million Americans. And we see that about 5% of those have $1 million or more in the 401k. So we know 401ks are popular, right? A third of America is playing around with the 401k. They're going to work, they're getting the match, they're saving the money. We've talked about this before. They're mildly successful. Ultimately, since they've been introduced, about 40% of people that have been offered the 401k are actually taking place. So, I think 401ks are a good thing from a standpoint of savings. They, of course, take the money out before.
It forces you to save.
Totally. So
that's what I love about them. It forces you to save every 2 weeks.
I totally agree. The problem with the 401k, I think, is there's a lack of performance and then a false sense of success. And so a lot of times we sit down with clients and they say, well, my 401k has done really well. My 403b has done really well. My TSP has done really well. And then we start looking at the performance and I see that they've run a 6, 7, or 8% return. And I show them and I say, hey, did you know that the stock market's running, 10, 11, 12% return? And they go, no kidding. Well, the unfortunate thing about the 401k is it's extremely cookie cutter.
Yep.
So it's this thing that we talk about all the time of stock bond mutual fund. It's the most basic version of Wall Street that you can find.
Yep.
And they're using the funds and the ETFs to keep it quite simple. This is because of the safe harbor laws that guide it from the government. They don't want it to be dancing out in high volatility things. They don't want to end up on the front page of the paper. And so a lot of times we see clients coming in that are worth somewhere between $500,000 and maybe $2 million, and they've really been lulled to sleep into this idea that 6, 7, 8% return is enough. And in their defense, it makes sense because when you look backwards, you see someone like Peter Lynch, right? Peter Lynch was making 7.2% return at Fidelity Magellan. He was a household name. Well, if he was around today, he would be a nobody.
That's true. And one of the biggest, best things about it is it forces you to save. One of the worst things about it is because you're putting so much money into it, it appears like it's growing more than it actually is. And so that's why it's super important to have these analyzed. And they don't have to be mega complicated. Like, for instance, 59.5 is a big number, especially for people holding 401ks, because what that means is when you hit 59.5, you have the ability to roll a good portion, sometimes all of it, out into an IRA while still keeping that 401k open, while you're adding to it, but then you can do more sophisticated investing inside of an IRA. So you have a much more robust way of growing it and protecting it inside of an IRA than you would inside of a 401k. But oftentimes we run into people who are under the age 59.5 and they have a current 401k, and it's our job as fiduciaries also to make sure that's operating well for them too. And sometimes you can overinvest in them. I see that quite a bit. I'll see 6 or 7 different mutual funds inside of a 401k, and people have their money so far spread out that they're experiencing a couple different things. They're experiencing investment overlap. They're experiencing maybe some of the mutual funds aren't producing. They might be too conservative. And you mentioned, 7, 8%. That's a big deal if you're hitting 8% a year. And it's because of the law of the 72, right? So 8 times 9 is 72. 8%, 9 years in a row, you double your money.
Wouldn't you say that that's a big deal if you had a certain level of risk, right? It's the relationship between risk and return that matters.
100%. 100%. One of the biggest issues that I'm seeing, though, let's say people have a 60-40 portfolio inside of their 401k, which means 60% is stocks and mutual funds, and the other 40% is either money market or bond funds. they might be averaging 8% on the stock side of things, but their bond funds or their protected side of their portfolio might be getting 1 or 2. That's an issue, and that's something that you can actually bump up. And the sexy thing to talk about is the growth, right? Everyone wants growth. No one comes in our office and says they want less money. However, if your defensive money can give you something north of, 4 to 6% a year, that is an absolute game changer on how your total portfolio operates, isn't it?
And it's interesting that you pose it that way. So I just happened to Google it to see, okay, what are the average returns of 401k here in America? The average return falls between 5 and 8%. So as you just mentioned, there are things that are safe that can make 6%. I don't think a lot of people realize that they're taking on high levels of risk to make a 5-6% return. They could easily be sitting in something that is extremely safe, extremely predictable, low volatility. And so when the market goes down, they're not feeling a lot of pain, a lot of stress. They don't realize that because they're, last 20 years, last 30 years, last 40 years of their life, they've been watching that 401k ride up and down and up and down. Well, you don't have to ride up and down. We literally designed our strategy around this concept, which is called protection rotation. Mm-hmm. The idea is if you don't lose as much money, you're a buyer. So when clients come in, they're used to the roller coaster, up and down of the cookie cutter Wall Street stock bond mutual fund model. And we're able to introduce some things, roll that to an IRA, and then take away the drama, take away the dips and the falls inside that roller coaster to give them more consistency. And then over time, more return.
You can't put a plan together where you can actually limit your losses and take advantage of those downs in the market and add to stocks or add to your growth models. So when it does come back up, you're taking advantage of it. And that's what we do every single day for people out here. It's tremendously important to have these types of plans put together, especially when you're getting closer to retirement. Give us a call so we can help you put together a plan that can give you the clarity and the confidence to move forward in retirement. 404-640-5511. That's 404-640-5511. Or you can find us online at unleashyourmoney.com.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.